Despite recent gains, the Dow still on track for its worst first quarter ever. Joining us now by phone is Keith Banks, head of investment solutions at Bank of America. Take it to the banks. Take it to the banks, Keith. Thanks for coming on. Let me just try to summarize. I think what you're saying, it's as simple as this. If you are not fully invested, start dollar cost averaging in. Does that kind of sum up what you think we should be doing? If so, into what?
Yeah, Joe. I mean, right now what we're urging clients to do is you need to have a longer-term view, number one. And if you find yourself below what would typically be, a equity allocation, then we're saying you should take your time, but slowly move, re-risk, slowly build up your equity position and get yourself back to what would be a more normalized level of equity exposure. And within equities, we like large cap U.S. still. That would be our first choice as far as where money should be going. Okay.
And, maintain diversification, go multi-asset, do all the things that you would normally do, but just stick to this country and stick with large caps. Any sectors in general you like, I don't know, financials, staples, healthcare, tech, what do you like?
Yeah, I mean, kind of all of the above, Joe. I mean, what you're seeing right now is there's where is there a scarcity, right? There's a scarcity of growth. There's a scarcity of yield. There's a scarcity of safety. So we're trying to find, within the U.S., those sectors that would give you those types of exposures, whether, as you said, whether it's finance, healthcare, tech, on a kind of a barbell standpoint, you can get exposure in staples, utilities. But, look, the key right now is I think a lot of people are trying to get clever and time the market. And the reality is it's time in the market, not timing the market. If you go back to 1930, if you had just stayed exposed to the equity market, your returns would have been around 15,000%. If you miss the top 10 performing days of each decade over that period, your returns would be 91%. So people get drawn into, there's this gravitational pull when the markets are gyrating around. People want to sell when the market is getting hit really bad, or they think they're missing it when markets start to go up a lot, and you tend to do the wrong thing at the wrong time. So that's why, again, we're saying have a long-term perspective, be disciplined, and just build your way back to what a longer-term equity exposure would be for you.
And maybe cushion some of the volatility with some treasuries and some gold as well, and then that's your portfolio, right, in a nutshell, Kate.
Yep, and just hang tight, and again, we're confident we'll come out of this, and just don't be zigging and zagging. That never works.